Imagine waking up this morning, opening your portfolio, and seeing red everywhere. Bitcoin down, Ethereum bleeding, altcoins collapsing. And for a few seconds, you just stare at the screen. Is this just another dip? Or the beginning of something much bigger? Over the past few weeks, the crypto market has entered one of its most turbulent phases in recent history. What initially looked like a routine correction has now turned into a wave of fear sweeping across global markets. Billions of dollars have vanished. Leveraged positions have been wiped out. Traders who were confident just days ago are suddenly questioning everything. And here's the real danger. It's not just Bitcoin falling. When Bitcoin moves violently, the entire ecosystem shakes. Ethereum, Ripple, and major altcoins have mirrored the decline. Liquidations across major exchanges triggered a cascading effect. Prices drop to leveraged positions get forced closed, to that selling pushes prices down even further, to which triggers more liquidations. It becomes a feedback loop of panic. Now ask yourself, if you were using leverage, would you survive this volatility? But this crash isn't just about charts and technical breakdowns. Zoom out for a second. Global macroeconomic pressure is tightening. The US Federal Reserve continues to maintain restrictive monetary policy. Inflation remains stubborn. Liquidity is no longer flowing freely like it did during stimulus-heavy years. And when liquidity dries up, speculative markets feel it first. Bitcoin is often called digital gold. But when real economic pressure builds, investors rotate back into traditional safe havens like treasury bonds and physical gold. Risk appetite shrinks. Capital preservation becomes a priority. So the question becomes, is Bitcoin acting like digital gold or like a high-risk tech stock? At the same time, institutional confidence appears to be softening. ETF inflows have slowed. Major funds are reducing exposure. Regulatory uncertainty across different countries continues to create headlines. And psychologically, that matters more than most people realize. The fear and greed index is drifting toward extreme fear territory. And here's something important. Markets are not driven by charts alone. They are driven by human emotion. Panic spreads faster than logic. Social media amplifies worst-case scenarios. One influencer says, buy the dip. Another says, this is the beginning of a crash. Timelines flood with conflicting predictions. In moments like this, hesitation can be costly. But impulsive decisions can be even more dangerous. For investors in Pakistan and South Asia, things become even more complex. Regulatory ambiguity, banking restrictions, and unclear legal frameworks add another layer of uncertainty. Prominent Pakistani crypto commentator Waqar Zaka has repeatedly emphasized disciplined risk management during extreme volatility. His argument is simple. When markets become unstable, preserving capital is often more important than chasing aggressive gains. And history supports that idea. After the 2018 bear market, many investors who over-leveraged were wiped out. During the 2022 collapse, including the dramatic downfall of FTX, panic selling dominated headlines. Yet eventually, Bitcoin recovered and reached new highs. But here's the part people forget. Those recoveries came after prolonged pain. Severe drawdowns, months of consolidation, emotional exhaustion. Right now, the market reflects multiple risks converging at once. Leveraged liquidation pressure, institutional withdrawal, macroeconomic tightening, regulatory uncertainty, and psychological contagion. Technically, Bitcoin is approaching key psychological levels. Zones where buyers previously stepped in. If those levels hold, we may see consolidation. If they break, downside could accelerate rapidly. On-chain data tells a mixed story. Some large holders appear to be quietly accumulating. Meanwhile, short-term traders continue exiting positions. That divergence raises an important question. Are strong hands buying while weak hands panic? Crypto markets are asymmetric. A relatively small group of large players can influence price direction through strategic liquidity control. Retail investors often react emotionally, and usually late. So what should you do? Hold and trust long-term recovery? Partially reduce exposure? Diversify into stable assets? There is no universal answer, but there is one universal principle. Risk management must come before optimism. Experts across financial institutions suggest that in volatile phases like this, probability often favors short-term downside continuation before sustainable recovery. That doesn't guarantee collapse, but blind confidence can be dangerous. There's a psychological trap in downturns. First comes denial. It's just a dip. Then comes fear. What if it never recovers? Successful investors avoid both extremes. They focus on structured strategies, position sizing, staggered entries or exits, diversification beyond crypto, and monitoring macroeconomic shifts closely. Bitcoin remains the flagship cryptocurrency. Its technological foundation as a decentralized digital asset remains intact. It has survived multiple cycles of boom and bust. But survival does not mean immunity from volatility. What makes this phase different is the simultaneous pressure from global economic tightening and shrinking speculative liquidity. Earlier cycles were fueled by easy money and aggressive stimulus. Today's environment demands caution. Yet history teaches another lesson. Extreme fear often plants the seeds of future opportunity. Markets tend to overshoot in both directions. Forced liquidations create discounted valuations. Strong hands accumulate quietly, while weak hands exit loudly. The coming months will determine whether this becomes a temporary correction or a prolonged bear phase. Recovery, if it comes, will require macro stabilization, renewed institutional confidence, regulatory clarity, and improved sentiment. Until then, the most important question isn't, where is the exact bottom? The real question is, how much risk are you willing to tolerate? In volatile markets, capital preservation can be as powerful as capital growth. Bitcoin's journey has always been defined by extremes. Extreme optimism, extreme fear, extreme volatility. This chapter is no different. But in times like these, the winners are rarely those who react emotionally. They are the ones who stay calm, analyze rationally, act strategically, and prepare for multiple scenarios. Because in crypto, uncertainty is permanent. But disciplined decision-making can turn turbulence into long-term advantage. For smart, disciplined crypto analysis without the hype, subscribe to the channel. New market breakdowns coming soon. See you in the next episode.